Thank you all for joining this edition of the MTA podcast series. My name is Jeanette Young. I am the director of the CMT program for the Market Technicians Association. And today, I'm pleased to be joined by Todd Harrison. Todd, who is the founder and CEO of Minyanville, has 18 years of experience on Wall Street. After graduating from Syracuse University with honors in 1991, he spent 7 years on the worldwide equity derivative desk at Morgan Stanley as vice president. In 1997, he became managing director of derivatives at the Gallion Group. 3 years later, he joined a $400 million hedge fund, Kramer Berkowitz, as a partner, head of trading, and was president from January 2001 to January 2003. From July of 2000 through September of 2001, Todd was featured columnist on TheStreet.com, RealMoney.com financial website. In December 2008, Todd received an Emmy Award from the National Academy of Television Arts and Sciences for his role as executive producer of Minyanville World in Review, the first and only animated business news show. Welcome, Todd, to the MTA podcast.
It's good to be here.
I hear you're writing an ebook every Wednesday called Memoirs of Minion, which is featured on your website on Minyanville.com. Can you tell us a little bit about this?
Sure thing. It's Memoirs of a Minion is, it's the story of my life, but in many ways it's a lot of people's stories as we edge through these last few years. And, I share my tale with hopes that others can learn from it in many ways. And, what it is effectively, it's a story about the false idolatry of money, which may seem a little strange coming from somebody who was, built a career on Wall Street. But it talks about how, as a child, I was programmed to believe that net worth was self-worth, and having fun was the same thing as being happy. And I chased that status, and in many ways believed that validation could be found in the bottom of a bank account or in the bottom line of a P&L. And I got to where I thought I wanted to be. I ran through the ranks of Morgan Stanley, through Gallion. 31, I found myself as the president of a $400 million hedge fund. And then I experienced some things that shifted my perspective. Losing people who were close to me, being down near ground zero at September 11th, 2001, and decided to take my life in a different direction and create a platform to affect positive change through financial understanding. And I've learned a lot of lessons when I was no longer doling out the type of money and commissions that I was doling out. I learned a lot of lessons about myself. I learned a lot of lessons about people. I learned a lot of lessons that I think made me a better man and reprioritized the way I look at the world and the way I look at myself. So I share those lessons with a very honest introspection, and it publishes every Wednesday on Minyanville, and I think people are enjoying it.
Well, isn't following your passion a profitable adventure?
Well, it is, and I will say that I don't make the type of money that I did when I was running a large hedge fund, but the psychic income has never been higher. And
Okay.
there's a lot of glib adages out there. Do what you love, and the money will come. And knock on wood, you can say that Minyanville, things have really blossomed. And in a way that really wasn't about the money. I didn't start Minyanville to make money per se, but when I started to take in investors, it clearly became my fiduciary responsibility. And we've built a global community that I'm very proud of. We're read in over 100 countries. In July, this past July, in the middle of the summer, we did 10 million page views and had over 1.5 million unique visitors. And it's a community where truth and trust is really our mantra, where honesty, trust, and respect and your name and your word still count for something. And I think that truth and trust are commodities going forward. And we've built a platform that isn't a traditional media platform in terms of a horizontal swath, but is a vertical experience from the ABCs to the 401ks, where we have Minion Land, for children to teach them earning, spending, saving, and giving, and all the way up that learning ladder to Minyanville.com, and our animated series, as you said, won an Emmy Award, and then we have a host of premium products, including the Buzz and Banter, which is real-time analysis of the markets throughout the day through myself and about 40 other people who I have tremendous respect for. So wherever you are on that learning ladder, there's something for you at Minyanville, and we think we've cracked the code.
Speaking about the learning ladder, I know many of our listeners are not terribly clear as to what a hedge fund really is. I mean, I know you've spent 3 years working at a hedge fund. Can you tell us, A, what it is and what it's like working at a hedge fund?
Oh, there's a lot of different types of hedge fund structures. I work at a long-short hedge fund. We bet primarily on equities through the common stock, and my background is in the derivative market. So whether it was at Galleon, where I worked after Morgan Stanley, or whether it was at Kramer Berkowitz, we primarily operated through derivatives, or that was at least a very integral part of our operating construct. But there's a lot, there's a multitude of different structures in terms of hedge funds. But the nuts and the guts of it is.
What type of derivatives did you trade?
Equity options. I've always traded equity options.
So you were doing spreads, you were doing packages, you were doing butterflies, you were doing ratios, things of this nature.
Sure. Whether it's a hedge or, there's two primary uses for options, the hedging strategies or as a speculative strategy. So,
do you miss it?
Use options, in terms against your overall book, or you can use them as vehicles for individual stocks. But the term structure, at least the way it used to be was, you get a management fee and then you get a performance fee. Typically that's been 1 in 20, 1% management fee, 20% performance fee. I get the sense that structure is going to shift going forward as a function of the kind of seismic change in the financial field right now, where I anticipate there's going to be a 3-year lockup on money going forward, where an aggregate performance will dictate returns, and there's no high water marks from year to year. At least that's what I foresee coming down the pipe.
Do you miss working at a hedge fund?
It was the best of times. It was the worst of times. I mean, it was one of those, it was one of those lifestyles that I think from the outside looking in, it's easy to say, these are guys who, had it all, and they didn't, they were overpaid. But I'll tell you, from my perch, I don't know if there was ever a year I worked at a hedge fund where I didn't eat what I kill, and everything comes at a cost. Everything has a profound cost to it, and that's one of the reasons after 9/11 and after that kind of that turn for me, that internal turn for me, I left the hedge fund, the big money hedge fund world, and I probably, with the benefit of hindsight, left a few years early. I probably could have made a lot more money if I stuck around, but I have no regrets. I mean, part of the decision to leave was a lifestyle decision, because it was just all consuming. It was, sleepless nights. It was $20-30 million swings in a day, and it was just it does take its toll on you. There's a reason why it's a young person's game. Ironically, I started a small business at the time, and I thought that was going to be a lifestyle shift. Little did I know that I ended up working harder on Minyanville than I ever have in anything else in my life. But there's not a day that goes by that I regret it. I will tell you that my definition of professional nirvana has always been to do what you love with people you respect while serving the greater good. So aside from Minyanville, we have the Ruby Pack Foundation for Children's Education, which I started in memory of my grandfather. So I can't wait for Mondays. I look forward. I can't wait to get to my desk, and I can't wait to be surrounded with my team here.
That's a wonderful way to be. Well, looking forward to today's market, I mean, the FOMC did, in their statement, suggest that economic activity was leveling out to more horizontal from a vertical move, and banks are showing that, or have shown this past year, that they are tightening up their lending and average levels over the past few months. What are your thoughts about the market going forward?
Well, I think whenever you have tighter lending practices, at the same time you're trying to induce the velocity of money, there's an inherent conflict or inherent friction between those agendas. What I will say, taking a step back and looking at what we're traversing through right now, and I do believe that this is one of the more interesting times in the history of global financial markets. The last 2 years, year and a half, 2 years, and we have as a context, we've been talking about these cumulative imbalances that we're building in Minyanville for years. And since 2002, they were manifesting in different ways. Bubbles were migrating from one to another. The dollar, devalued by 35% since 2002, and the spending habits, the economic infrastructure was skewed by the spending habits of a slimming margin of society. So this has been building for some time, and to appreciate where we are, we really got to understand where we came from. I'm of the view, and going into that fateful September, when we talked about on Minyanville, all the corporate debt that was coming due, one of two things had to happen. Either we were going to see a cancer that would chew through different sectors. It started with the home builders, moved to the financials, and then to financials and drag or companies with large finance-based operations, and that would manifest. Or you were going to see a car crash where the wheels just fell off the wagon. My analogy, for lack of a better analogy, is that with the bailouts and everything that happened, the government effectively bought the cancer and they sold the car crash, or they staved off a systemic collapse in order to give the patient a chance to stabilize and then recover. And I think they did that, but again, that came at a profound cost. So if you further that analogy, I think it's going to be difficult to run a marathon with cancer. I think that it's going to manifest, and it is manifesting in different ways, and that's a movie, not a snapshot, and it most certainly isn't a soundbite that's going to be fit into a podcast, but it's what we talk about every day on Minyanville.
Right. With in today's David Rosenberg piece, he said that despite the government stimulus, the economy is going to be limping along for a prolonged period of time as savings rates rise and debt ratios decline. He also brings out in this piece that he wrote this morning that the crisis has been prolonged and that we are looking at a nightmare of rollover debts. What do you think about that?
Well, I think there's two paths, and I have great respect for David. And I agree with him on many fronts. I look at, I'm very. If you haven't picked up on it, I use a lot of metaphors to try to communicate what I'm seeing in the market, and I'll continue that by saying that there are two things that could happen. One, which is giving the economy drugs that mask the symptoms, which is what I think we've been doing for a long time. And the other is providing medicine that will cure the disease. And in my estimation, we continue to give the market drugs that mask the symptoms with hopes that we're buying more time. And again, I'll go back to the reality that there are cumulative imbalances, and there's just much too much debt in the system. The only true medicine from my perch is time and price. So through that lens, we're one step closer to eventually where we're going to arrive at. But most importantly, debt destruction. I think you need to see debt destruction. If you see an orderly debt destruction process take place, I think that will pave the way to true globalization. I often use the analogy that everything that they said the internet was going to be proved true, but not without a technology crash. I think everything they say globalization will prove true, but not without debt destruction. And I think that will be painful, but it is a necessary step as we move along here, and it's going to be a prolonged process, and it's going to be a socio-economic process. This is no longer just financial, or economics. This is social. And this is going to take some time. You're seeing that manifest through social mood and through risk appetites. If that process is not allowed to happen, and granted, it's not been a natural progression anymore. It's been one that's been influenced greatly, and some would argue probably correctly that something needed to be done to stabilize the patient. But again, if what we see starting to manifest, it now becomes protectionism and isolationism, and countries, sovereign nations start protecting their own interests, and you start seeing people covering up, as I think that we're starting to see, then you're going to see a manifestation of these policies percolate in an entirely different direction, and I think that's going to be, the slicing and dicing of the globalization process in a way that's really not going to benefit anybody, but at the same time will be necessary from the viewpoint of sovereign nations protecting their own interests, and that's where I think societal acrimony could morph into social unrest and potentially geopolitical strife. So that's what scares me the most, but that's not something you can necessarily trade, day to day. That's just something as a context where I would offer capital preservation and financial staying power are your two greatest allies, and there will be profound opportunities on the other side of this. We often talk in Minyanville about how the leaders coming out of a crisis are never the same as the leaders that enter a crisis, and we talk about how the Great Depression was a construct for optimism. When you have companies like Disney and the Washington Post and Texas Instruments and Tyson Foods and Continental Airlines all born, rising like a phoenix from that scorched earth, I think you're going to see very much that same pattern play through where there's going to be new leaders, new opportunities, and great fertile ground for growth, but you're going to need to be in a position to prosper when it arrives, and therein lies the importance of financial staying power.
I'm listening to you speak of globalization. Do you believe then that the boundaries of the globe are open to all of us and that we may see a migration out of the U.S., let's say, to other countries which are friendlier tax-wise to the residents?
Well, I think that's a political question. I do believe in and there's a difference between being bullish and being patriotic. And I love my country. I will tell you that I do believe that if true globalization is to arrive, it's going to be in my opinion, an outside-in recovery. It's going to be led by the Chinas and the Indias of the world, or the Hong Kongs of the world, the Far East, and I think that that's okay. I don't think that this is that going forward globally. There's no place for ego in globalization. If you remember the front end of the technology bubble, the rationalization for the price appreciation was globalization. What we've seen over the last 2 years is the other side of that trade. That sword swings both ways. And I think that, the risk to that is going to be political risk. I think it's going to be foreign holders of dollar-denominated assets who have watched their measuring stick of their investments decline by 35% over the last 7 years are growing increasingly frustrated. And I think that there needs to be calmer heads prevail. I think there needs to be diplomacy, and I think there needs to be, the proper perspective that this is not something that you're going to throw a Band-Aid on and walk away, and it's going to get better. What we're seeing right now is the attempt to the transference of risk from our generation to the next. That's what the plan is right now, and that's going to hope. That's what the plan is right now. And my honest opinion is that is no longer our decision. I think that decision now resides in the hands of foreign holders of dollar-denominated assets, and whether or not they can extricate themselves from a derivative machination, first of all, that is north of $500 trillion and is tying the global world together. It's a finance-based, derivative-laced global economy. So, we all are in this together. This is no longer a USA versus Japan versus Brazil equation. This is, how do we move together forward and do so in a way that's gonna, that's gonna be a peaceful progression rather than, one that, blows up.
As a very last question, because I know you really have to get back to doing what you do best and love to do, how does the media and outlets like Minyanville and Kramer, how do they influence the prices of stocks and sentiment of the markets?
Well, I think that that's a pretty subjective question. What I'll say is, I can speak to Minyanville and our whole approach. And I founded this shortly after 9/11. What I would say is our whole approach is, we're not going to give advice to people. I don't know what your time horizon or your risk profile is. I can't speak to your specific needs. So I think, through that lens, it's a very dangerous game to speak to a screen and offer advice when you don't know the risk profile or time horizon of your audience. What we do in Minyanville is we talk about what we're doing, why we're doing it, and how we're doing it through a vicarious learning process. And hopefully, we're provoking thought, and we don't necessarily have all the answers, but we're going to ask the right questions. And we're going to do so in a way that does not have acrimony, that does not, that tries to steer clear of just the embedded friction that's really percolating throughout the societal structure right now. And I think that media, by and large, is going through a drastic change. That's probably not a news flash. But, we talked earlier about how the leaders coming out of a crisis are never the same as the leaders that enter a crisis. So I think we're seeing that in the financial sphere. I think boutique firms are taking market and mind share from the legacy players, the once powerful legacy players. Although I do believe that human capital, there's a lot of human capital in the financial industry, and I think at the end of the day, that's going to shine through in one way or another. And I think we're seeing that in the media space with the emergence of the internet. Is let's call a spade a spade. The internet is the world's it's the most deflationary invention in the history of the world. It's the democratization of information. It's almost an overabundance of information, and I think that's changed the way media is operating. In that traditional networks are simply channels in the digital age, and I think a lot of them are trying to catch up. But while they're trying to pave their path, I think upstarts that have less baggage, balance sheet baggage or overhead baggage, have the ability to trade to win, so to speak, not trade not to lose. I think as long as you trade not to lose, you end up losing. So it's an exciting time. It's a scary time, but it's a time that I think if you are lucid and pragmatic and don't get caught up in a bigger, better thing and take proactive responsibilities for your decisions, I think this is going to be not only a generationally opportunity. It's going to be a pathway for generations to come.
Thank you so much. This has been the MTA podcast series. My guest today has been Todd Harrison, founder and CEO of Minyanville. Thank you again, Todd, for your wonderful contribution. I'm Jeanette, saying goodbye for today. Bye.